Are you thinking about buying a business? The way you structure the deal, an asset sale or an equity sale, can make all the difference for your taxes, liabilities, and long-term success. But what's the real difference between the two, and which one is right for you? Hey taxpayers, it's Tiffany Gonzalez CPA here with a video directed to my followers looking to buy a business. If you're aspiring to be a business owner, watch this video to get your new venture started right. Let's begin by defining what these terms mean. An asset sale is when you buy a business's assets, things like inventory, equipment, customer list, intellectual property, but you're not taking on the legal entity itself. On the other hand, an equity sale, also called a stock or a membership sale, involves buying the ownership shares of the business, meaning you're purchasing the company as a whole, along with its legal structure and its liabilities. Let's imagine you're interested in buying a small coffee shop. With an asset sale, you're buying things like the coffee shop's coffee machines, the brand name, the recipes, the customer list. However, you're not taking over the actual LLC or the corporation that legally owns the business. Instead, you can use a new LLC that you've set up, and that LLC will hold these new assets. Some benefits of an asset sale are, first, reduced risk. This approach gives you a fresh start, especially if you're concerned about any liabilities that the business may have. For example, if the coffee shop had any unpaid debts, lawsuits, or tax obligations, these typically stay with the previous owner since you're only acquiring the assets, not the legal entity. Second is the flexibility. You can pick and choose which assets you want to buy, allowing you to pass on things that might not fit your vision or add value. Third, asset sales allow for depreciation. But there's also some downsides to consider. For example, reestablishing contracts. You may need to transfer or renegotiate with existing contracts that are current with vendors or customers or landlords, since these agreements are typically in place for the original LLC. You might also lose some tax benefits. Sometimes an existing business could have existing rollover losses available for use to the new buyer. Now let's talk a little bit more about an equity sale. In this scenario, you're buying the business entity itself, which might be a corporation or an LLC. You're stepping into the shoes of the previous owner, meaning you're taking over everything: the assets, the liabilities, the legal responsibilities that come with the business. So why might someone prefer an equity sale? Here are some pros. First, continuity. In an equity sale, the legal entity remains unchanged. So contracts with employees, suppliers, or customers often stay in place, making for a smoother transition. The second is tax benefits. In some cases, equity sales can provide tax benefits for the seller and potentially for the buyer if the business assets have already had significant appreciation. And the downsides here, in contrast to an asset sale, are that when you buy equity, you inherit the business's legal obligations, including debts, pending lawsuits, and potential tax issues. Of course, due diligence is crucial here. Before buying a business, you'll need to conduct an in-depth review of financial records, liabilities, employee agreements, and legal obligations to avoid surprises. This means that because of this complexity, equity sales can take more time and effort to finalize. Deciding between an asset sale and an equity sale really depends on your goals, the type of business you're buying, and your comfort level with potential risks. If you want a clean slate and minimal exposure to past liabilities, an asset sale might be ideal for you, especially for smaller businesses with simpler assets. On the other hand, if maintaining continuity is critical, such as keeping client relationships or vendor agreements intact, an equity sale might be worth the added complexity. Equity sales tend to be more common for larger businesses with more substantial goodwill and client relationships. I hope you found this video helpful. Don't forget to hit the like button, subscribe to our YouTube channel, and follow us on LinkedIn, Instagram, and Facebook at Accounting to Scale. Until the next video, your favorite CPA, Tiffany Gonzalez.